The US economy just crossed a line most people don't even know exists. Not a recession, not a correction, a stage. A defined, documented pattern that economies follow when they begin to break down from the inside. And right now, in 2026, the data confirms it. The United States has entered Stage 3. Stage 3 is not the beginning. The beginning already happened, quietly, while headlines were focused elsewhere. And it is not the end. But Stage 3 is the point where the collapse stops being theoretical and starts being felt. In your grocery bill, your rent, your job security, your savings. Here's what makes this moment different from every other economic warning you've heard before. This isn't a prediction. It's already happening. The indicators that define Stage 3, currency devaluation pressure, debt spiral acceleration, institutional credibility erosion, and consumer purchasing power collapse, are all active, simultaneously. That combination has a historical track record, and that track record is not reassuring. What comes next is the real story. To understand where the US stands today, you need to understand how it got here. Because Stage 3 doesn't arrive overnight. It builds, slowly, deliberately. And by the time most people recognize it, it's already embedded in the system. Stage 1 began with what looked like manageable debt expansion. Post-2008, the US made a structural decision: print, borrow, and stimulate. It worked. For a while. Markets recovered, GDP grew, confidence returned. But the foundation had shifted. Stage 2 accelerated after 2020. The pandemic triggered the largest monetary expansion in US history. Trillions injected in months. Supply chains fractured. Inflation surged to levels not seen in 4 decades. The Federal Reserve responded with the fastest rate hiking cycle in modern history, which slowed inflation but quietly fractured something else: the debt servicing capacity of the US government itself. By 2025, interest payments on US debt crossed $1 trillion annually. Not the debt, the interest alone. That is the moment Stage 2 ended. And here is where it gets serious. Stage 3 is not defined by one crisis. It's defined by systems that were holding everything together beginning to fail at the same time. That is exactly what the data shows right now. So what does Stage 3 actually look like on the ground? Not in theory, not in economic textbooks. Right now, in 2026, in real, measurable data. First, purchasing power. The US dollar buys significantly less than it did 4 years ago. Cumulative inflation since 2020 has eroded roughly 20 to 25% of consumer purchasing power. That gap has not been recovered. It is structural, not temporary. Second, debt dynamics. The US is now borrowing money to pay interest on money it already borrowed. That is not a warning sign. That is the definition of a debt spiral. The Congressional Budget Office projects this trajectory gets worse every single year through the end of the decade. Third, institutional credibility. Credit rating agencies have already downgraded US debt. That happened, quietly, without the panic it deserved. Foreign central banks are slowly, methodically reducing dollar-denominated reserve holdings. But this is where the story changes. Each of these signals alone is manageable. Economies absorb shocks, systems adapt. What makes Stage 3 different, what makes it a stage and not just a rough period, is the convergence. All three are happening simultaneously, and they are feeding each other. Weakening dollar raises import costs. Rising import costs accelerate inflation. Inflation forces higher rates. Higher rates increase debt servicing costs. Higher debt costs accelerate borrowing. More borrowing weakens the dollar further. That is not a cycle. That is a spiral. Here is what most coverage is missing. This is not just an American economic problem. The US dollar is the world's reserve currency. That single fact means every stage of this collapse carries global consequences that extend far beyond American borders. When the dollar weakens structurally, not temporarily, structurally, the entire architecture of global trade shifts with it. Oil is priced in dollars. Commodities are settled in dollars. Sovereign debt across emerging markets is denominated in dollars. When the dollar loses credibility, that entire system comes under pressure simultaneously. And right now, that pressure is building in 3 directions at once. China and Russia have been systematically building alternative settlement systems for years. The BRICS expansion in 2024 was not symbolic. It was structural. A direct move to reduce dependence on dollar-based trade infrastructure. Saudi Arabia is now accepting non-dollar payment for oil in select transactions. That was unthinkable a decade ago. And inside the US itself, the Federal Reserve is caught in a trap with no clean exit. Lower rates to relieve debt pressure and inflation accelerates. Keep rates high to control inflation, and growth stalls while debt costs spiral. That trap is the defining feature of Stage 3. There is no policy tool that solves all three problems at once. Every move made from here involves a trade-off, and every trade-off has a cost that ultimately lands on ordinary people. What changed structurally is this. The US has lost the policy flexibility it once had. That changes everything about what comes next. Here is what the decision-makers actually understand and are not saying publicly. The US government is not unaware of Stage 3. The data is visible to anyone with access to Treasury reports, CBO projections, and Federal Reserve meeting minutes. The awareness is there. What is missing is a politically viable solution. And that gap between awareness and action is itself one of the most dangerous features of Stage 3, because the decisions being made right now are not designed to solve the structural problem. They are designed to manage appearances long enough to delay the most painful consequences. That is a rational, short-term political calculation. It is a catastrophic, long-term economic one. Here is the hidden pattern most people are missing. Every major economy that has passed through Stage 3 in modern history followed one of two paths. The first, painful but controlled restructuring. Spending cuts, currency stabilization, institutional reform. Difficult, politically costly, but survivable. The second path, delay, denial, and debt monetization. Printing money to cover obligations, inflating away debt, destroying purchasing power gradually until the system resets violently. Right now, the policy signals coming out of Washington point toward the second path, not because policymakers want collapse, but because the first path requires a political consensus that does not currently exist. Massive spending cuts mean political opposition. Structural tax reform means powerful resistance. Genuine austerity means electoral risk. So the system keeps moving, borrowing, spending, inflating, and Stage 3 deepens quietly while the debate continues. But the other side tells a different story, and it deserves to be heard, not dismissed, because it is not without logic. There is a credible school of economic thinking that argues the US situation, while serious, is fundamentally mischaracterized by collapse frameworks. The core argument is this. The United States is not Argentina. It is not Venezuela. It is not Weimar Germany. Comparing US fiscal stress to historical collapse cases ignores critical structural differences. The dollar's reserve currency status is not just a title. It is a self-reinforcing system. Global demand for dollars is structurally embedded in trade, debt markets, and financial infrastructure built over 8 decades. That does not unwind in years. It unwinds in generations, if at all. The US also retains something most collapsing economies lacked: deep, liquid capital markets. Foreign capital still flows into US treasuries during global stress events, not because investors love US fiscal policy, because there is no comparable alternative at scale. And on the debt spiral argument, optimists point to GDP growth potential. If productivity accelerates, driven by AI, energy transition, and reshoring manufacturing, the debt-to-GDP ratio stabilizes without dramatic intervention. That is not an unreasonable scenario, but here is where the optimist case has a critical gap. It requires everything to go right simultaneously: strong growth, controlled inflation, stable geopolitics, political cooperation on fiscal reform. Right now, not one of those conditions is fully in place. Betting on best-case outcomes when systems are already under Stage 3 stress is not analysis. It is hope, and hope is not a strategy. So what does Stage 3 actually mean for you, specifically, practically, in your daily life? Because this is where the analysis has to get personal. Start with food. The US imports significant quantities of food inputs, packaging materials, and agricultural chemicals, all priced in a global market increasingly sensitive to dollar fluctuation and supply chain stress. Food prices in 2026 are not rising because of temporary disruption. They are rising because input costs are structurally elevated and not coming back down. That is permanent, not temporary. Housing. Interest rates elevated to combat inflation have frozen the housing market. Existing homeowners locked into low-rate mortgages cannot move. New buyers face monthly payments that would have purchased significantly more home 4 years ago. Homeownership, historically the primary wealth-building tool for middle-class Americans, is now functionally inaccessible for a growing segment of the population. Jobs. Corporate margins under pressure from elevated input costs and slowing consumer spending translate directly into hiring freezes, reduced hours, and quiet layoffs. The official unemployment number does not capture underemployment, people working below their skill level or below the hours they need. Savings. Inflation running above wage growth means every month you hold cash, you lose real purchasing power. But risk assets, stocks, real estate, are themselves under pressure from the same structural forces. There is no clean, safe harbor. And this is the defining feature of stage 3 at the personal level. The options that worked in previous economic cycles are no longer delivering the same protection. The system that rewarded patience, saving, and conventional financial behavior is operating under different rules now. Most people haven't adjusted yet. That gap between old assumptions and new reality is where the personal financial damage of stage 3 is accumulating silently. So where does this go from here? Not in theory. In realistic, data-grounded scenarios, short-term and mid-term, based on the trajectory stage 3 has established. Short-term. The next 6 to 12 months are defined by managed deterioration. The government continues spending. The Federal Reserve navigates between inflation control and growth support. Markets remain volatile, but not broken. Consumer stress deepens quietly. No single dramatic event, but a steady, measurable erosion of financial stability across the middle and lower income spectrum. This is the most likely near-term path, not a crash, a grind. Midterm, 2027 to 2028 is where the scenarios diverge sharply. Path 1, controlled correction. A political consensus emerges, however painful, around genuine fiscal reform. Spending is restructured, revenue is addressed. The debt trajectory bends, the dollar stabilizes. This path is economically survivable. It requires political will that currently does not exist, but it remains possible. Path 2, accelerated stage 4 entry. Debt costs continue crowding out productive government spending. An external shock, geopolitical conflict, energy disruption, a major sovereign debt event, hits a system with no remaining policy buffer. The Federal Reserve is forced to choose between hyperinflationary money printing or a deflationary debt crisis. Neither option is clean. Neither option is painless. History suggests external shocks do not wait for systems to stabilize before arriving. And right now, the global environment is not stable. Middle East tensions, US-China strategic competition, European economic fragility, energy market volatility. Every one of these is an active pressure point on a system already operating inside stage 3 stress. Here is the unresolved truth. The United States has the resources, the institutional capacity, and the economic depth to navigate out of stage 3 without reaching stage 4. That capability is real. But capability and political will are not the same thing. The window for a controlled correction is open. It will not stay open indefinitely. What happens in the next 24 months will determine whether this is a chapter in American economic history or the beginning of its most defining crisis. The data is clear. The pattern is established. The question now is not whether stage 3 is real. The question is whether the response comes before stage 4 does. If this breakdown gave you clarity that mainstream coverage isn't delivering, share it with someone who needs to understand what's actually happening to the economy right now. This is the analysis they won't simplify for you elsewhere.